Welcome to PhillipCapital's Experts Talk. My name is Lindsay from Unit Trust Research. Today, we are privileged to have Dr. Bill Maldonado, Chief Investment Officer, Asia Pacific and Strategies Chief Investment Officer for Equities globally, from HSBC Global Asset Management, to take us through the investment prospect of Asia Pacific equities. A brief background of Dr. Maldonado. Based in Hong Kong, Dr. Maldonado oversees the investment strategies in the region. He has worked in the asset management industries since joining HSBC in 1993 as a European derivative-based portfolio manager. Over the past 20 years, Dr. Maldonado has headed up a number of investment functions, such as non-traditional investments, including passive indexation mandates, fund of funds, structured products, and hedge funds. He became Strategy CIO, Equities, and CIO for the UK in 2010. He was also involved in the management of some Asian portfolios in Hong Kong during 1993 to 94. Dr. Maldonado holds a PhD in laser physics from Oxford University and an MBA from the Cranfield School of Management. Thank you, Dr. Maldonado, for taking time to attend this interview with us.
Okay.
Let's start off with Japan, shall we? Japanese stocks have been highly influenced by the value of the Japanese yen, as a significant proportion of earnings growth is actually repatriated from overseas. Throughout April, the yen has remained stagnant, fluctuating between the range of 101 to 104 against the USD. Meanwhile, sentiment for Japanese investments continued to decline, with the TOPIX contracted 3 to 4% in April. Could you share your stance on the Japanese equities market?
Sure. Well, I think there's a couple of different areas that we could focus on. First of all, on the currency, I think that people, investors in general, assume too much influence from a weaker yen on the Japanese corporates. And there's a couple of reasons why we think that. Number one, Japan has spent 2 decades trying to insulate its corporates from a strong yen. And the way it did that was to offshore manufacturing as much as possible. So it will benefit, because of those measures, it now stands to benefit a lot less than one might expect from a weaker yen. Secondly, in certain industrial sectors, take electronics for instance, Japan, if you add up the total market cap of all Japanese electronics companies, it adds up to about 150 billion US dollars. Samsung's market cap is $200 billion. So even with a weak yen, it's very difficult for corporate Japan to compete in certain areas anymore after 2 decades of being pretty stagnant. So I think the real issue is less the currency and more the third arrow of Abe's policies. And the third arrow is about structural reform. The first two were monetary and fiscal policy, which I think they've done a very decent job on. But on structural reform, I think that's very difficult to bring about in Japan. Just culturally, it's very, very tough. And structural reform really means loosening controls on the labor market, effectively making it easier for companies to hire and fire people in Japan. It's very difficult today to do that. And as I say, culturally, that's going to be very, very difficult. So until we see some progress on that, I think the market is going to remain skeptical about the ability of the Abe government to really drive change in the economy. And I think we're going to continue to see stagnation, exactly as you say, effectively flat markets that are more driven perhaps by earnings than by anything else.
Exports could remain a drag on the economy in the current quarter instead of cushioning the pullback in domestic demand, as consumption takes a hit from the April 1st sales tax hike. Front-loading of consumption with the falling out in the immediate periods after the tax hike is inevitable, while manufacturing PMI fell to contraction terrain in April on concern on future consumption. if there's no prompt bounce back, Abenomics may be at risk. In your view, do you think that Abenomics is actually working?
Well, as I think that the first two arrows have worked. You could say for the first time in 2 decades, consumer inflation was positive, barely positive, but positive. So, in some ways, I think it's worked, and I think we have to give credit to Abe and his government for at least having the determination to do something about Japan's problems. But I think they're big problems, and I think it's going to take more than fiscal and monetary policy to get out of them. It wasn't fiscal and monetary policy that got them into those problems. It was a whole host of other things. So I think it's going to be difficult, but I think that they have a genuine desire to bring about change. So I think we shouldn't be too skeptical. Shorter term, as you say, there's going to be a hike in consumption taxes. Actually, I think that the blow that might cause otherwise to the consumer is going to be cushioned a bit by other measures. So I don't think it's going to have a very negative outcome as it did the last time around that they tried to do that or something similar. So I'd be less worried about that. But really, we're very focused on structural reform, and as yet, there's very little evidence that that's happening.
Moving on to Asia's largest economy, China. Despite the guidelines published by the People's Bank of China on deepening capital market reforms, front-loading government spending, and other measures to spur growth, the disappointing industrial production, retail sales, and fixed asset investment data further intensify the concern on China missing the 2014 target growth rate of 7.5%. In your opinion, would it be a good time now to enter the market? If yes, any particular sector?
So I think that's a very interesting and very challenging question to answer, actually, because there's 2 parts to the question. There's one on the economy and what that's going to do, and one on the market. And actually they are different things. The Chinese economy has done superbly well over the last 20 or 30 years. It's a world champion that's never been beaten in terms of sustained growth. And yet, actually, equity markets have been very disappointing for investors over most of that period. So I think we always should think of markets separately from the economy. That's true for any country, but I think it's especially true for China. So on the economy, we do think that government and policymakers, the PBOC and others, understand the problems and are really determined to do something about it. And I think they have the firepower and they have the means to bring about that change. So we're confident about their ability to restructure the economy. It's going to take a while, it's going to take years, and the change that's going to bring it about is going to be incremental rather than big bang. So sometimes investors get very impatient with that, but that's the way it's going to happen in China. It's not going to happen any other way. But we're very optimistic about that process, and we're not the only ones. The IMF, who have a mission in country, are also very optimistic in their latest report and talk about significant buffers existing in China to cushion the economy from a slowdown. I think it matters less whether exactly what the growth rate is, as long as there's not a very big decline in that growth rate. I don't think it matters a huge amount if the exact target is hit, but as long as there isn't a very big decline. As far as the market is concerned, I think the thing we should be more focused on there are things like the trust sector, the sort of off-balance sheet banking sector coming under control, which it seems to be doing. Some progress and resolution on bad debts and bankruptcies, which I think we're getting. Some progress on the housing market, which has slowed down a bit, and We'd like to see how that's going to play out. And more broadly on SOE reform. So what shape is that going to take? In China, it's very unlikely that it's just going to be wholesale privatization of SOEs, but probably it's going to be about mergers of SOEs. It's going to be about transferring some of the assets to private companies, as they're doing in the case, for instance, of gasoline stations, to try and make those assets more productive. So I think those are the things that investors are more focused on in terms of the markets. It's slightly different from the economy.
As Premier Lee said, slower growth is now the new normal. In your view, what are the catalysts that will spur growth in the Asia region in near term as Asia's powerhouse embarks on reforms and rebalance?
Yeah, that's a great question. I'm not sure that anything is going to spark growth, because that sounds as if there's going to be something that ignites a rapid surge in growth, and I don't think that's going to happen. But I don't think we need that either. Asia has actually been very resilient, both in terms of its economies and its markets. And I actually, if I could choose, or if you let me and my colleagues choose, we probably wouldn't choose to reignite anything. What we'd rather have is slow, steady progression, which is a lot easier to manage from a policy perspective. It's a lot more sustainable. It's a lot more longer lasting. So I think what Asia is doing, broadly speaking, is transforming itself from being a low-cost manufacturing outsourcing center for the world to being much more about its own consumption and much more about innovation and high-end manufacturing and R&D and things like that. And that's exactly what the economies need to do as they go from being a low GDP per capita block of countries to being a high GDP per capita block of countries. It's a natural development, and I think that's happening. So as long as nothing interrupts that, as long as we've got no nasty surprises waiting, I think that the outlook for Asia is very, very positive. We're very optimistic about it.
India and Indonesia. India and Indonesia had suffered high inflation, capital flight, and currency devaluation last year on the back of twin deficits. This year, stock markets rebound as their current account and fiscal balance improved, shaking off their fragile five tag and regaining investors' confidence. Stock markets has been rallying, fueled by hopes of a stable and reform-oriented government after the election. With the Sensex and JCI current PE ratio at 17 times and 22 times respectively, do you think that the market are overstretched?
I think Indonesia, the equity markets we're talking about now, I think the Indonesian market is very expensive. I think it's the most expensive market in the region for its level of profitability, which is the way we like to think about the world. You know, how expensive is something relative to how profitable it is. So I think the economy is in good shape. I think that they've tried to address inflation, they've tried to address the current account deficit, they're doing all the right things. So we don't have any big concerns today about the economy, but the market is very, very expensive because people loved the story of Indonesia. They love the demographics, the growth, and there's a lot to love. I mean, absolutely, it's a great story, but the question now is how much are you prepared to pay for that? And we would say currently we're being asked to pay more than we think we're prepared to. In India, I think it's a bit different. India's not cheap, but it's nowhere near as expensive as Indonesia. And India's not cheap based on its historic growth rates. But if the current government can break the deadlock, it can break the logjam on infrastructure and a lot of the other key things, key projects, key policy areas that it needs to do, they could really unlock an era of much faster growth in India. And we're actually very positive about that. We think that there's a good chance that they can do that. We don't underestimate the task. I don't think it's going to happen immediately. So probably over the next few months, you're going to get an opportunity to buy the market cheaper than you can today, immediately after the election, because we're still reeling from the great news that we had as investors over the election, and I think it's probably got a little bit carried away in the short term. But medium to long run, certainly it's very, very positive. And as I say, we hope that it's going to herald a new area of growth for China. I mean, China has grown at something like a half to 2/3 the growth rate of China. There's no reason why it can't do the same thing that China did and sustain a much higher rate of growth for a very long period of time. That is not priced into markets. That would really propel markets forward very significantly.
Having said that, do you think that the bull market will continue post-election? And what are the risks to monitor?
I don't think it's going to be an uninterrupted bull market after the election. I think it was very strong over the last few days of the election and into the results. And actually, the market level hasn't been so much. The focus and headline of the market has been more about what's happened in terms of rotation within the market. And the defensives have got really quite beaten up. They've bounced a bit now, but they got sold off, and the cyclicals and financials rallied. And we benefited very, very much from that because we saw that there was a huge amount of value in those cyclicals and financials. But I think, whilst I think that rotation will carry on, and I also think that the market level will go up, I think that there are going to be times as Modi unrolls his cabinet, the policy agenda, the priorities, there are going to be times when investors are not quite so positive about the story, and there's likely to be periods of weakness. So I don't think it's going to be one direction up from here. I think there is going to be volatility and opportunities for investors.
As what you have shared just now, recently we also see the US market experience a sharp rotation out of the hyper growth momentum stocks into the more value oriented stocks. Do you see the same in the Asian market other than the India market?
Yes is the short answer. So, but I think in the US, I wouldn't characterize it as a rotation out of hypergrowth stock. I'm not sure there are any hypergrowth stocks in the US, or none that we would characterize that way. But certainly, there's been a rotation more towards cyclical and financial, sort of old economy, industrial names. And I think that's absolutely right. Again, we've benefited from that because our process takes us towards those kinds of stocks. It's very hard for us to get excited about expensive stocks that are displaying normal levels of profitability, which is what characterized a lot of the stocks that have been doing very well in the US. And I think that phenomenon is happening all around the world. In Asia, right across Asia, you see defensives as being very, very expensive relative to cyclicals and financials. That's unwound a bit during March and April. And if you were correctly positioned for it, you've made a lot of money out of the rebalancing. But it's taken 2 or 3 years for that position to be built up by the market, for that anomaly to grow to the very large extent it had grown to. And I can promise you it's not over in 2 months. It's going to continue. There's a lot more to go. So I'd say that's one of the very big opportunities we see for investors is in cyclicals and financials.
Within Asia Pacific region, which are the countries or sectors you are most optimistic on?
So that's a good question, and it's the answer is driven by our bottom-up view. We try not to take big top-down macro calls because they're very, very hard to make. How are you going to make a call on the Indonesian election or the Indian election, Thailand? Very, very hard to make the call. And even if you get the call right, how do you know what's then going to happen in terms of the economy and the markets? Very, very difficult. So our views are more informed bottom up, and where we find very cheap, very profitable cyclical and financial stocks is in North Asia today. So we find them in Korea, in Taiwan, in Hong Kong, and especially in China. So those are the places where we have our overweights, where we have our favorite positions. We find a lot of good stocks like that as well in India today. The Indian economy is more, or the market is more fairly balanced, but again, there's a very big disparity between cyclicals, financials, and defensives, especially when you bring state ownership into the equation. So there are public sector banks and public sector utilities which have done phenomenally well because they got so cheap and they were very profitable. I think in ASEAN, particularly in Philippines, Indonesia, Malaysia, much harder to find cheap cyclical financial stocks because those markets have been so popular for such a long time. So we're less excited today about prospects there. We think the economies are great, we think the markets are great, there's a lot to like. It's just the price we're being asked to pay today for the assets in those markets. It's a bit too much for us to be comfortable with.
Thank you, Dr. Maldonado, for sharing your insights with us here today. For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.